All right, Bob, you'll have control of the slides. I would like to introduce you. For those who don't know, and I'm sure most of you do, we're so pleased to have Robert Keebler here with us. He's a distinguished partner with Keebler and Associates, and he's going to present today handling large IRA distributions. This session, you're going to learn about Roth conversions, thoughtful trust design, charitable planning, and strategic distribution approaches that can improve inherited IRA outcomes and enhance multi-generational tax efficiency. Bob's practice focuses on wealth preservation and transfer planning, charitable giving, retirement distribution planning, and estate administration. He frequently represents clients in IRS audits and has secured more than 350 favorable private letter rulings. Bob is especially known for designing strategies that achieve optimal estate and income tax results for his clients. Bob, we're so pleased that you're here today, and I'm going to hand it over to you. You should be able to use your mouse or your left and right keys to forward the presentation.
Well, thank you, Kathleen, and good afternoon, everyone. It's an honor to be here. What a great topic, and the topic is so timely. And we've had such a good stock market. It's very common for people to come to see me I just talking to a lady early this morning, and I think she and her husband have close to $10 million in IRAs. And she's, what do we do? How do we approach this? So that's some of what we'll talk about. Let me get, okay, Kathleen, for whatever reason, the slides, oh, there we go. So we'll go through the Secure Act. We'll talk about strategic planning for large IRAs, talk about some very basic trust concepts, talk about a trust as a beneficiary of an IRA. We'll look at charitable planning with IRAs, and we'll talk a little bit about life insurance. Now, the software you have through Cloud Financial Work will help you with a lot of this. Okay, so that's the good news. Now, if we go further, what Secure did is it basically took everything from a life expectancy payout to a shorter 10-year payout, except there are 5 exceptions to those rules, which are called EDBs, eligible designated beneficiaries. And if you fall within one of those 5 exceptions, you basically can use life expectancy. Now, there's some odd rules with minor children. We're not going to spend a lot of time on that because rarely, I think in doing this for 40 years, I've represented maybe 15 children under age 18 who have lost a parent. So it's not even once a year. Now, Secure 2.0 came along. And basically, the big thing there is they added this new code section 327 for surviving spouses. What you really need to know is if the spouse is under 59 and a half, you have to stop and figure out whether or not you should do a rollover. Or if there is a big age gap, if the younger spouse died. So the gentleman died, he was 60, his wife is 70, she's still very much alive, but he died, then you might not want to do a rollover. Other than that, the go-to in most first marriages is going to be a rollover, a plain, boring rollover. Now, the rollover doesn't work when the surviving spouse is under 59 and a half, okay? So you want to be very careful with this. Oops, I think I went. Let's go up one more slide. Now, you have non-designated beneficiaries, and then you have EDBs, which are the eligible designated beneficiaries. Most of the time, you're going to be dealing with an eligible beneficiary. Very boring, a natural person or a qualified trust. Just as boring can be. Now, starting on the far left, whenever you see an IRA designated to charity or to an estate or to a non-qualified trust, you need to be very careful that you get the payouts right. Because if you fail to get the payouts right, you're going to get hit with a 25% penalty. Now, you're saying, Bob, wait a minute, the penalty is 50%. No, it used to be 50%, then they changed it. Now, if you have somebody that goes back 10 years from ago and they messed all this up back then, they'll have some of the penalty at 50% and some at 25. The good news is on all these penalties, the statute expressly allows for a waiver. Okay, so you can, CPA or lawyer can get that waived. When you have a real person or a qualified trust, most of the time you're going to have a 10-year payout. So the money would come out over a 10-year period of time. If you have an eligible designated beneficiary on the far right on your screen, that's my wife, my child who hasn't reached age 21, an individual who is chronically ill. I met with a couple this morning. Their daughter is 28 years old and probably falls into either chronically ill or disabled. And we have to work on that definition a little bit. But if they died, their daughter would get life expectancy. Now, qualified trust, you can have a qualified trust for an eligible designated beneficiary. For example, a special needs trust. This is going to come up all the time. And when you have this, you need to get those clients to a lawyer who is half special needs lawyer and half estate planner, and he or she will draft a trust in such a way that you'll get all the special needs protection along with the good result from being an eligible designated beneficiary. By having the right language for the life expectancy payouts. Now, the fifth bullet point is an individual not more than 10 years younger, the same age or older than the IRA owner. All we're talking about here is my brother is 5 years younger than me, almost to the day. And if I died and left him something, he would be able to take the money out over his life expectancy. Actually, a better deal than my own children, okay? So that's important to look at. Now, also an older person. I die and I leave my IRA payable to my Aunt Catherine. She would be able to take the money out over her life expectancy. Okay, let's look at the next slide, please. Now, these RMD things, don't even try to memorize this. Remember, you have this April 1st date, but you're going to have to just look it up or keep a slide like this on your desktop. It depends on what year you were born, when you started. So right now, anyone born between 51 and 59 is going to be on an age 73 start, okay? And basically anybody born 1960 or later will be age 75. Now, obviously, you can take money out before then, but you can't. But after that point in time, you have to start taking out RMDs. Let's go up to the next slide. This is a nice chart that Kathleen put together for us. Basically goes through, when did you die? Are you an individual? Are you a surviving spouse? And you have to be careful. As the financial advisor, you want to avoid giving legal or tax advice, but you're going to be confronted with these situations all the time. So you want to be able to identify them, triage them, get all the facts, and then just confirm the advice, okay? That's all you really have to do, okay? And I appreciate sometimes it's difficult to find a CPA or lawyer who can keep up with you on these rules because you probably have had more exposure to these rules recently. But in order to protect your client in case the advice is wrong from the penalty, that advice really should be confirmed with a lawyer, an accountant, or CPA, not an accountant, CPA. Okay, next page. And this just goes further on this nice chart Kathleen put together. Again, do not try to memorize this. I think, especially for people that are, say, over age 40, everybody grew up in an environment where you had to memorize everything. That's not the case right now, okay? We can rely on looking things up. We can rely a little bit on AI as long as we verify. Um, AI is far from perfect, but it can get you started in the right direction, but you still have to verify against source materials, against the regulations, the statutes, etc. Now, what you want to avoid is generally a lump sum distribution. That hardly ever is the right result. We also want to avoid being stuck with the 5-year rule. And you can get stuck with this 5-year rule when you have the wrong beneficiary if the owner died before the required beginning date, age 73 right now. Now, here's the deal. These beneficiary forms really have to be drafted perfectly to get here, okay? And the best practice is for you to ask the client's lawyer to draft those beneficiary forms for these larger IRAs so they're woven into the fabric of the estate plan. So all the money gets to where it's supposed to go. Next paragraph, please. Now you have this traditional IRA, RMD flowchart. Nice little cheat sheet which will walk you through how does money come out of an IRA after somebody dies. Is it going to the spouse? Is it going to a non-spousal individual, for example, a child? Is it going to an estate or a charity or to a trust? And again, so what you really want to do from a planning perspective, when you're looking at this, I come in to see you and you say, Bob, who's the beneficiary of your IRA? And I go, oh, it's my estate. At that point in time, you should know that, wait a minute, that's not right. We have to get that fixed, okay? Or if my goal is to leave most of my estate to charity, but you see my IRA is going to my children and my will says everything to charity, that's backwards, right? We want to make sure that the IRA goes to charity and that the property that receives a step up in basis goes to my children. So you just have a ton of opportunity here. And for everyone you're helping, you do want to look at their beneficiary forms and make sure they're, again, woven into the fabric of the estate plan. That is just so critical for all of us to understand. And you're going to be forced to make mathematical choices. And we'll talk about that a little bit. The largest choice being the Roth conversion decision. Let's look at the next paragraph. Okay, now, when I die, this is important. There is going to be a 10-year rule when I die. And if the money goes, if I die before my required beginning date, and the wealth in that account goes to somebody that could take it out over 10 years, they do not have RMDs along that journey. So I die today, it goes to my oldest son, Grant. He doesn't have to touch it for 10 years. And then he has to fully distribute, third bullet point here, he has to fully distribute the account by December 31st of the 10th year after death. Now, this applies to deaths after 12/31/2019. If you died before then, you're still able to use life expectancy. That's what's so important. Now, if you die after your required beginning date, then you have to take RMDs along that 10-year period of time. It's just a table calculation. It's not real hard, but it's important to know that. I want you to write on the page, Roth IRA question mark. With a Roth IRA, you are treated as dying before your required beginning date. And if you're treated as dying before your required beginning date, that is great news because you don't have to take any money out along that 10-year journey. So you're not going to take any money out along that 10-year journey. That's very, very important. If we look at the next slide. Now, when you die before your required beginning date, sometimes you have to read the plan document if you don't have a nice, clean beneficiary. But then you're going to end up with either the 5-year rule, the 10-year rule, or qualified designated beneficiary life expectancy rule. Those are kind of your choices. And now, sometimes if you do not have a beneficiary, the plan will draft a beneficiary for you. The best result on that, or the best example of that, is when I have an ERISA plan. If I die today, my 401k plan at the office automatically goes to my wife. It doesn't matter that I put my brother down or our children down or my sister. All that matters is that my wife and I are married. ERISA says it goes to my wife. The only way an ERISA plan wouldn't go to my wife is if she signed what's called a RIA waiver. This is all very important to understand. Now, the one thing that you want to be very mindful of is if I die, okay, if I die, we want to be very careful on that. I've updated all my beneficiary designation forms. And what happens is sometimes I've had people I've represented, they've left their IRA to their ex-wife, who they divorced a long time ago, or they left their ERISA plan to their ex-wife. And if you leave an ERISA plan to your former spouse, guess what? It goes to your former spouse, okay? So these are big things. Now, that's not always true if you're remarried, but this is an area where you just want to make sure after a divorce, you get people to update everything, okay? So that's going to be very, very important. Look at slide 12, please. Now, you have this stretch option. The stretch option applies to a narrow group of people called eligible designated beneficiaries: a disabled person, a chronically ill person, surviving spouse, someone less than 10 years younger. Now, in the surviving spouse, most of the time, we're just going to do a boring rollover. But sometimes we would go with the spouse's life expectancy. Now, RMDs typically are going to begin a year after the owner's death. Remember, at the end of the day, you're not going to have to take money out if you died before your required beginning date. And there's a little formula. You go to what's called the single, right-hand side of the page. You go to what's called the single life table, and you divide the IRA by that single life expectancy factor. Pretty easy, straightforward approach. Okay, next page, please. Okay, now let's get into the strategic planning. We're trying to set a direction. Okay, so this couple comes to see you. Imagine the last couple you met with kind of a large IRA. What should we do? That's a multifaceted question. And the question is, do we have a Roth IRA or a regular IRA? If it's a Roth IRA and we're trying to focus on wealth transfer, if we don't have an estate tax, most of the time, we're just going to try to defer the distributions. If it's a regular IRA, after somebody dies, then you have to time the size of the distributions and when you take them to manage tax brackets, okay? And so if somebody their parents die, and they're given a $500,000 IRA and they come to see you, and they say, how do we take this out? What you want to focus on is basically how do we manage tax brackets? Maybe the lady is still working. She's a dentist. She's making $600,000 a year. She's going to work for another 2 years and then retire. You wouldn't take any money out to years 3 or 4. You'd try to defer best you could to stay out of those high bracket years. The thing to do is spread out a client's income so you can see what is the best way to approach that. If we look at the next slide, talk a little bit about Stella. Stella's age 66, thinks she'll live to 85, converts $100,000 at the 24% bracket. So Stella's doing a Roth conversion. Now, pays tax on the conversion from the IRA, 6% before tax rate of return, and 5% after tax. Nora is the beneficiary. Okay, so let's look at the next slide and see what happens. And when you look at this, you basically, if you did a Roth conversion, you're going to pay tax on the conversion. And this just walks you through each year, okay? All we're doing is we paid some taxes up front, and then we're left with 76,000. That just grows. There's no money that comes out. That can grow into the day Stella dies. And then we can let it grow for another 10 years after that. If you increase the ROI, it's going to look even better. And there's some money management issues of where do we put our stocks and where do we put our bonds. Ideally, if you're just doing this for wealth transfer and you can afford the risk, you'd put bonds in the Roth IRA and you'd put the stocks that should grow faster in the Roth IRA, and then in the regular IRA, you'd put the bond portion of your portfolio. Now, if we look at the next slide. Now, basically, in this case, Nora would get $194,000, but she doesn't have to take anything out until the last day of the 10th year. This is fantastic for Nora. So Nora's in a really good spot. She doesn't have to touch anything. She can let it grow for an entire 10 years, and then we're moving in the right direction. Okay, let's look at the next slide. 6%, a little bit more. You can see the math. I mean, the math is very powerful. I think the math is important for people to understand what to do. This largely cannot be taught conceptually. You have to get the numbers in front of people on the Roth conversions. So it's very important. Most people aren't going to have an estate tax, and these Roth conversion decisions are going to be driven primarily by brackets and by some wealth transfer aspects without the estate tax. If we look at the next slide. Now, again, Nora, if you look what's happening here, Nora would basically take our traditional IRA, she's going to be taking out RMDs. If she was a Roth IRA, she wouldn't have to take any RMDs until the 10th year. Okay, but she does have to take out RMDs. The financial cloud software will do that calculation for you. If you jump up to the next slide. Now, this is a very illustrative of the issue. If we look at the wealth transfer, okay, we compare the orange Stella and Nora Roth at 6% to the 6%, the lighter blue on the far right. We end up with more money with using a Roth IRA versus a regular IRA. And what's going on here is that deferral can be quantified, okay? Not having to touch the money for 10 years can be quantified in a very big way. Let's look at the next slide. Okay, now these three gentlemen are triplets. Connie dies in 2025 with a $3 million IRA. Derek, David, and Daniel are equal beneficiaries. 49 years old. Each empties the account differently. The first one, 6% before tax, 9% after tax ROI. Then we have 24% bracket, whose value is the highest in year 10, okay? So basically, again, the 6% is what they're left with after tax, okay? 6% is the pre-tax ROI. So if you look at that and we give it time, Derek took the money out and reinvested it. Now, he is going to end up with about $1,881,000 in the lower right-hand corner. Let's look at what happened to his brothers. Now, Daniel smoothed it out over 10 years. And so he's going to be able to manage some brackets. He's going to come out better than Derek, okay? Now, David, let's look at the last example with David. David's the big winner here. David doesn't take anything out, lets it grow. All that growth in the Roth IRA is completely tax-free. So one of the things that you really want to look at is how much money did they end up with? And the difference is amazing. Okay. So the difference at the end of the day is about $387,000 of difference. That is a big, big number. So we just need to put that math into play. Okay, look at the next slide. So now you can leave your IRA to a trust. There is absolutely no doubt on that. When you leave your IRA to the trust, you accomplish a lot of great property law things. Okay. And most people should probably be leaving their property in trust for their children for asset protection, to protect it from their spouses, to protect it from the child himself, and to allow property to fall down to the next generation. And for example, if you're in New York or Connecticut or Massachusetts, Vermont, where you have a state estate tax, this is especially true in Washington state, okay, where you have an estate tax, basically every generation, every 25 years, those are crazy numbers, right? And what we need to be conscious of is if I die and leave property in trust for my children, and then when they die, it goes to the grandchildren, they do not pay estate tax on what's in that trust. That's what's so critical in this overall planning. Let's go up to the next slide. Now, when a traditional IRA goes to an estate or trust, most of it is going to be taxed at a 37% rate. However, if the trustee pays the money from the trust to the beneficiary, then the beneficiaries pay the income tax at their trust, not at the trust rate, but at their individual tax rate. And this is really critical because what's going to transpire is you're going to be in a lower rate. Now, this chart is important for a number of reasons. The first thing we want to see is look at how low the rates are, 10 and 12%, kind of at the bottom of the economic market. Now, the other thing we need to be very mindful of, I just had a client die at the end of November. Now, his wife is in good health. She'll be single for a long time. And look at where the brackets are. When they were married, the doctor and his wife could have $400,000 of income and only be 403 and only be in the 24% bracket. Now, it's even higher than that because itemized deductions, now the standard deduction. But look at where she's going to be. That single rate is half the married rate. This becomes very critical in your thinking and your analysis. So remember, this is one reason when we get to Roth conversions, we're going to talk about this, but a big reason to do Roth conversions between spouses is to take advantage of those married brackets. Look at the next slide, please. Now, there are two types of income: fiduciary accounting income and trust account or in tax accounting income. When we talk about fiduciary accounting income, we're talking about state law. What does state law say is income? Nothing to do with tax. In the concept, it goes back hundreds of years to a British concept of corpus and income. And the concept is corpus would be, for example, the land, and the income would be the crops that come off the land. That's how a lawyer or an accountant would describe that 250 years ago. And that's set by state law and by the trust instrument. It determines the required and permitted distributions. But then you get a tax accounting income, and that is how we determine who pays the tax. Okay, so this is something that you just want to understand when you're doing financial planning for a surviving spouse, how these trusts work, how income will flow out of them. Now, the value of my IRA at death is typically part of my principal. And if those stocks go up in value, that's still going to be part of principal. But under state law, every state's going to differ. There's two main approaches to this. There's the 10% of the RMD approach, and then there's the 4% of corpus approach. And why does this become important? This becomes so important because you're going to have a document that says, I leave all income to my loving wife, remainder to my children. And of course, the surviving spouse wants what she's entitled to under income. And you have to sort through what is income and what is principal. Now, that would typically be the responsibility of the CPA doing the tax returns for that client. Okay, next paragraph, please. Okay, now, when income is distributed from a trust to a beneficiary, that income actually carries out from the trust to the beneficiary. That's the whole concept of D&I, distributable net income. So if a trust earned $100 and kept the money in the trust pays the income tax. If a trust earned $100 but paid the $100 out to the beneficiaries, then the beneficiaries pay the tax. Think of it like the pitcher, the water pitcher in the little page here on if the income stays in the trust, you pay tax to the trust level. If the income sprays out to the beneficiaries will pay the tax. Okay, so now don't worry too much about the computation of D&I. The CPAs can figure that out for you. The software does most of the work right now. You do have a special rule. Now, when you have a trust, normally you'd want to be paying out distributions during the year. However, if you pay out distributions, this is critical. If you pay out distributions within 65 days after the end of the year and you make a special election, then those distributions are treated retroactively as having happened on December 31st of the prior year. So this gives you some time to figure out what was income of the trust, how do we pay those, how much do we pay out, how much do we keep in the trust? And those are things. Now, to make this election, the CPA has to file an income tax return and make the appropriate elections. It's a bit tricky, but nothing that a CPA that does a lot of fiduciary income tax work couldn't figure out. Okay, next paragraph. Now, this is your tax return, what it looks like for a fiduciary income tax return. On, I think it's line 18, you have, basically, that's where we have that deduction. So if a trust earned $100 and paid out $90 to the beneficiaries would pay tax on $90, and the trust would pay tax on the balance of $10. Next slide, please. Okay, now, can we name a trust as a beneficiary of an IRA? The short answer is absolutely yes. A trust can be made as a beneficiary. Now, why would you do this? Look at this family here. You have the mom and the dad, and then there's the young lady. And if mom and dad died, you don't want this young lady receiving the money when she's 18. You'd leave it to a trust, and then she would receive it, if at all, at some later date. In the meantime, the trustee could pay for school, other expenses, etc. But the last thing you'd want is her to receive at 18 for obvious reasons. We know that. We've seen that won't end well. Okay, go to page 38, please. Now, you have a qualified look-through trust. If you have a qualified look-through trust, a trust must meet 4 requirements. It must be valid under state law, irrevocable at death, the beneficiaries must be identifiable, and you have to provide the documents to the custodian by October 31st, the year after death. Those are the things we need to do. Now, what to know next? And when you have a trust, what type of trust do you have? Who's the primary beneficiary? Are there multiple beneficiaries? And really determining the payout for how that's going to come out, whether you're going to be able to use the 10-year rule or some type of life expectancy rule, you're going to have a CPA or a lawyer look at that and sort through that. And it's very subspecialized work. Now, separate shares. I say in my will, I leave 25% of my IRA to a trust for each of our 4 children. Those would be treated as separate shares. And the beauty of separate shares is everyone can determine, they have to figure out their life expectancy, but basically they can determine how to take the money out of their share. Okay. And that's a powerful thing. And so sometimes, most of the time, we're going to be able to use the primary beneficiary's life expectancy. That's not always true. You have to be very careful. That's why you need to get a tax opinion on this. So if we look up at the next slide. Now you get into this whole concept of a multi-generational spray trust. This is if all the beneficiaries are under the same trust, and then we can sprinkle income out across these group of grandchildren here. Now, if this is the case, when you have grandchildren, they do not qualify for a minor beneficiary, okay? If these were your children, they would, but not your grandchildren, not your nephews and nieces, etc. But basically, if I die at 35, which was a long time ago, but if I had died at 35 with 4 minor children, they would have been able to, if this was today, they would have been able to take the money out over their life expectancy until they reached 21, and then gone over to a 10-year payout after that. There's a lot here. I have a lot of other materials. We post things all the time out on LinkedIn. There's just a lot there, and that may be helpful to you. Okay, we're on slide 40. We have a few minutes to go before Q&A. Let's jump up to slide 41, please. Now, when we get into the really technical part of this, you're going to hear things like special needs trusts, a type 1 AMBT, a type 2 AMBT. And, basically, the real question is, do I have a designated beneficiary trust? Am I going to be able to use the life expectancy of the eligible designated beneficiary? And the lawyers are going to prefer to use what's called an accumulation trust, because then the trustee is able to keep money in the trust if it's not time to give it to the beneficiary. Now, many times, especially when you're dealing with a disabled or chronically ill beneficiary, we are better off with a Roth IRA than a regular IRA. So here we go. Your clients, Gary and Barb, come to see you. Gary and Barb have a son, and he's legally blind, so he might well be disabled under these rules. And they say, we're going to leave our money to our son. Okay? And basically you explain, well, that you should be able to use his life expectancy. And they say, yeah, but if the money goes to the trust, it's going to get sliced and diced at 37% plus state. The sky is falling. Everything's going to go wrong. You say, well, Gary, you're 62 years old. Your wife is 61. What if we took the next 20 years and did Roth conversions? Pay the tax up front. And he goes, well, that might make some sense because we're in a 12% rate. The trust would be in a 37% rate. I'd much sooner pay at 12% than at 27%. And then you lay out a plan to accomplish that, okay? And that's very important. Now, remember when you have a minor child, okay? So if, for example, mom dies, property goes to a minor child. That minor child is allowed to use their table life expectancy until they reach 21. And then they go on a 10-year, then the money comes out over the next 10 years. But this little girl is probably 3 or 4 at the most, and her life expectancy would be over 80 years. Okay. And you divide by 80, then 79, 78, 77, 76. It's pretty easy, right? And this would be very important to understand how that works. Okay. Now, when she turned 21, then you go on to a 10-year payout. Okay. But the important thing is to identify the EDBs up front. Okay. And, and what you're going to find is sometimes what you have to do, and there's Kathleen may have some ideas on other material, but the leading treatise out there, which everybody should have, is but from my friend Natalie Choate, Life and Death Planning. But sometimes when I run into a buzzsaw, when I get hired by one side and we're trying to sort all this out, and the other side is pushing back hard, I'll just send them, if Natalie's book spells it out, I'll usually send them a copy of the pages and just ask, what am I reading wrong? What don't I understand? Help me out, walk me through this. Most of the time I get a call back, Bob, you're right. Sorry I had this wrong, but this is how it's going to work. So now when you have a disregarded beneficiary example, now sometimes you're going to have an IRA that goes to a trust. Maybe that trust is for minor children, then in this case, the grandfather, and finally to the university if the children and the grandfather, everybody's dead. And this case, you have a 45-year-old doctor who dies unexpectedly. He has 2 children, age 15 and 13. His dad is the contingent beneficiary, and the remainder goes to his medical school. And if this is the case, you're actually going to be able to treat this as an EDB and use the children's life expectancy. So let's go up and look at one more slide, page 43. Now, or 44, if you have a conduit trust, then what's going to happen is all the distributions have to be paid out to the beneficiary. When you hear a conduit trust, it's exactly like a piece of conduit in the electrical construction world that just carries the wires, right? That conduit is just a flow through. If $100 goes from the IRA to the conduit trust, it immediately goes to the beneficiaries. And it's easy to make a conduit trust qualify for the longer payout. That's just a very important thing to understand. Now, when you have multiple trust arrangements, what's going to happen is, in this case, you have a see-through trust, a revocable trust, the standard revocable trust your clients use. And then you have a second trust as the beneficiary. If that's the case, under the new regulations, you're allowed to respect that second trust, okay? You can look through that second trust to the identifiable beneficiary. Now, all this nitpicky, does a trust qualify, what payout we use, none of that is that strategic. Most of that we're dealing with in a post-mortem environment. If the lawyer has done his or her job correctly, you'll be able to use the 10-year rule or the life expectancy rule. I think your job as a financial advisor is not so much as to understand everything the lawyer is supposed to be doing, but to understand this at a much more strategic level to determine how do we get to the best results. Now, sometimes people want to leave their wealth to charity. And the first place we'd start is up on slide 46. We can do what are called, in one more slide, please. We can do what are called QCDs. Basically, during my lifetime, I can take money out of my IRA. This year it's $111,000. Don't get caught up on the numbers. And that number changes each year. So just understand it conceptually. That goes directly from my IRA to my favorite charity. It never hits my income tax return. It never affects any of my other limitations or phase outs. Now, this isn't allowed for a donor advised fund, but you could leave it to your church or the Red Cross or Children's Hospital. I mean, not pretty easy. Now, this never hits your magi. It never hits your modified adjusted gross income. You don't even receive a charitable deduction for it because you don't need it because it never comes in income. Now, you can do this with a regular IRA, not a Roth. There's no reason you do something like this with a Roth. You do it with a regular IRA. Okay, now here's something that I'm working with right now with a couple of people. And they have 3 daughters, very large IRAs, embarrassingly large numbers to use his words. And when he dies, he could leave it to a charitable arranger trust. His daughters would get distributions for their life. And then when the 3 young ladies die, then it would go to his favorite charity. Now he can hardwire the charity. If the charity is Children's Hospital of St. Louis, done. We're good. And in this case, let's say it was just one daughter to make it easy. She would get distributions for her life, and then the remainder would pass to our favorite charity. So this is a very fantastic thing, okay? This is just very, very powerful. Okay, let's go up to now the charitable remainder annuity trust. Basically, when you have an annuity trust, you get a fixed dollar amount each year. If the initial value was $100 and you had a 5% payout, every year you get $5. Now, anytime you're using a charitable trust, I cannot make the numbers work that if somebody has no charitable intent, these numbers are going to be better than just leaving the IRA right to your family. Anybody that tells you that is probably not running the math right. But basically, the charitable trust can be powerful, especially when you want to benefit charity and you also want to take care of your family. The CRUT is a different beast, and this has to, every year the payment's going to change based upon the economic value of what you have in that account, okay? Now let's go up to the next slide. All we're doing here is talking about how dollars come out of a CRT. Basically, when I die, my IRA will go into tier 1, ordinary income, and when that flows back to my children, they will get ordinary income. Now, let's just say it was 10% a year, and after 10 years, they had burned up all the IRA income, but it had been invested in capital gain property. After that, we'd be getting capital gain out. And I ran some math. If you look up at pages 51, I took a 50-year-old person, 6% return, looked at the math of a CRT, and basically in page 52, you can see all the beautiful line graphs, but at the end of the day, a 10-year distribution and a lifetime CRUT after 29 years overlap each other. And why is that important? Because in the right situation, this person's 50, that would be age basically 79 if this person died today. While their children are still very much alive, they will be able to leave the same amount of money to charity or same amount of money to their children with a little bit more to charity. The CRT is very powerful. And write this down. CRT is a good idea when someone does not owe an estate tax. When they owe an estate tax, the math becomes different. But you want to educate yourself on how these CRTs work. You'll have to look at how to model them out. We do a ton of work on these CRTs, but almost everything, when we get into these advanced planning, sometimes we're using software we built, not really software, but Excel spreadsheets. I think I've looked at financial cloud work. There's a lot of good programming in there. You definitely want to have that at your fingertips. It's going to save you a lot of time. Okay, now this is if you look at both the beneficiary and the charity, you can see you're actually coming out ahead by using the CRT. Now, page 54, if you are in California or New York, you really want to work with the client's lawyers and CPAs and ask themselves the question, should the doctor in California leave his IRA to a trust in Nevada? Now, why would you do that? Because you see, the Nevada trust doesn't pay California income tax. And the beauty of that is then you don't pay any California income tax till the money flows back to the California beneficiaries. Now, if the beneficiaries are in, let's say, Nevada or Texas or Wyoming, or a state where the tax is more moderate than California, you'll never get hit with that 13% California tax. That's the beauty of that planning. Now, lastly, I want to talk a little bit about life insurance. We go up one more slide. Here's the concept. The concept is, can I create a greater wealth transfer for my family by taking money out over the next 15, 20 years of my life, and then using that money to pay the premiums on a life insurance policy that would be held in an irrevocable life insurance trust. Now, that actually, if we look up at the next slide, that is a beautiful plan when someone owes an estate tax. The Roth IRA is very powerful. Don't get me wrong. For people that aren't going to owe an estate tax, the Roth IRA makes sense. Now, for people that are going to owe an estate tax, the Roth IRA can still be a powerful tool. But generally, mathematically, when we run the numbers, the more powerful tool is to take money out of the IRA, pay the income tax, and then jettison the net into an ILET to buy second-die life insurance on husband and wife. This is very important. We can create quite a bit of wealth. There's a nice chart here, which show, and we're almost done, and then we'll take some questions. But basically, if we go up one more slide. So, what are you going to do with those excess of RMDs? Are you going to just invest them in your brokerage account, or are you going to buy insurance? And this works because the insurance is tax-free. And I think it can make a great deal of sense. If you go up two more slides, I ran the numbers on this. And this was for somebody that invests. This is an actual ledger. We're not licensed to sell insurance. We're just a CPA firm. But this person was $75,000 a year. They bought a policy for $1,175,000. The death benefit increased $75,000 per year. The way they designed the policy, but look at the line graph. What this says. Okay, the blue is the insurance. The orange is do nothing. They had a crossover point at about 93 years old. Most people aren't going to live to 93. Okay, so the insurance is going to create a greater wealth transfer for a person's family. That's the beauty of this planning. Okay, one more slide. We're now at the Q&A part. Kathleen, why don't you come back in? I know you had a couple of comments on the software, and then we'll take any questions that are available.
Well, thank you. This was so great. I love learning about the trust. And yes, you're right about Natalie Choate. She's absolutely who I go to as well. I've used her, my 20 years in this industry. So I can't say enough about what she can tell you either. All great things. So again, if you have any questions right now, you can put them in the chat to us, please. Again, I wanted to tell you that we are a 40-year-old startup, as we call ourselves. We specialize in IRA planning software and education, just like today's presentation. It's great to know numbers, but if you don't know the why behind it or the education, you don't have to memorize it. Just like Bob said, we have some information and we're going to send you some later on today along with the replay for you that helps you. Use these resources that we have available. I can't say enough good things about, so you said have it at your desk, look it up. Your clients want you to be knowledgeable. They don't expect you to memorize it all, but they expect you to know where to get that knowledge. Bob is a great place. We have great resources. They call me the IRA Oracle because that is what I've done for 20 years. My focus has just been IRAs. Our software follows the rules, which is why I was hired. Because if you don't have the rules right, then it doesn't matter what your calculation says. So that's why when we focus, our lane is IRAs. We don't go anywhere else. So the IRA rules are baked in. If you have newer people, your junior partners that are running the software, there are guardrails in place to help them. Also, if you're interested, like I said, we're going to send you the replay. There'll be a link if you ever want to book a time and look at your own client's information and run an illustration, have a consultation. If you mention that you're on the Bob Keebler call, we're going to give you a discount as well. Let's see about questions. Patrick, do you have any for us?
Yes. So, Bob, first question for you. Can a trust be drafted as a beneficiary deemed owner trust so income can be taxed to the beneficiary without it having being distributed to the beneficiary?
The short answer is yes, not a problem. You can do that because you make it a 678 trust and you give the beneficiary the right to withdraw the income. And that makes it a grantor trust with regard to the beneficiary.
Thank you very much. That's great. We have another question here as well. Can a spouse roll over an inherited IRA if the trust is the beneficiary?
Well, that's a tricky question. Okay. Most of the time, the answer would be no, because the trust wouldn't allow the trustee to pay the IRA to the spouse. But if the IRA is to the revocable trust, perhaps a mistake, and the revocable trust pays everything to the spouse, then we probably can reach into the revocable trust, grab the IRA, and roll it over into the spouse's name. And we've had PLRs like that. I just got one back in the last 3 months. I don't think it's been published yet on that very issue.
Well, that's great. I'm not seeing any other questions coming through, Kathleen, at this time.
Oh, wonderful. Well, I'm really glad that everybody was here today. I know we definitely got more than 50 minutes. We learned so much. Bob, I can't thank you enough for your great information. And with that, I will say thank you all and have a great weekend. It'll be coming up soon. I know it's only Wednesday. I'm getting ahead of myself, but enjoy.
Okay. Thanks, everyone. Thanks, Kathleen. Thank you, Patrick.
You're welcome.
Thank you, Bob.